This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company.
Okay, a little bit about Price and our relationship with him, really. You guys can go ahead and read through this, and I'm sure Price is going to tell us a little bit more about himself, but I've known Price for a little over a year now, and he's been a partner of ours for almost 2. We at Equus consider it and feel very fortunate to have him in Big Trends. I personally deal with many of the Big Trends customers, and I can tell you honestly, I always have positive feedback about him and the company and the coaches they have there. We're on our second version of the Big Trends toolkit now, and it turned into a much bigger project than we had originally thought, just because we wanted to add some things and change some things around.
Seem to have lost Jake there for a second. Just 1 second. Let's see if we can get Jake back here. One moment.
You guys hear me okay? Sorry about that. So, well, I'm not sure where I lost you, but basically we've put together just a fantastic product. I'm going to turn the time over to Price, and stay tuned afterwards. We have a really great offer for you guys, so take it away, Price.
Thanks, Jake. Always a pleasure to be here with you all tonight. Want to make sure everybody's able to hear me okay. If you can hear me okay, please type in a Y for yes. And also, where are you logging in from? Where's everybody checking in from? What part of the world? I always like to see where we get people coming in from. We've got Anna from London, Dennis in Pennsylvania, Nick, hello in San Diego, Colorado, Boston, Brisbane, Australia, Connecticut, another Australia, Singapore, another Pennsylvania, Knoxville, Tennessee, not far from me in Lexington, Kentucky, Greece, hello Thomas from Greece, another Boston, Las Vegas, Christchurch, New Zealand, Portugal, another Boston, Birmingham. So, well, welcome to everybody. New York, we've got people from all over the world. I think that's very much typical of what I expect from, MetaStock and, with the Reuters family, and now the Thomson having taken over Reuters, and just great organizations to work with. Bill, raised in Lexington, go Big Blue. That's the home of the Kentucky Wildcats. So glad to have a fellow Kentuckian in here with us as well. North Carolina, Argentina, just a tremendous worldwide audience. As you know, one of the real benefits of MetaStock is that the data feeds allow you to pretty much trade any market you want. Mike in Alberta, you got people from all over, just about every major continent here, every major market. And so, basically, what we're going to focus on here tonight is what I call catching the big trends using MetaStock. And as Jake alluded to, we have developed together with MetaStock, Big Trends and MetaStock, developed the Big Trends toolkit. And so what I'm just pulling up is a PowerPoint that should show you a little bit about how the toolkit works. I'm a big believer, having traded the markets for the last 18 years, that you've got to have an edge. You've got to have something that allows you to find the major movers. You think back on your trading experience, whether you've traded for less than a year or whether you traded for more than a decade. And what I find is that basically people, look back and kind of kick themselves at the trends that they saw, but that they, for some reason, didn't have the fortitude to stay with and to ride. And so a big part of what we teach at Big Trends through our coaching programs, which happen to focus and exclusively use the MetaStock software with our Big Trends toolkit we're going to talk about tonight, is strategies that can keep you on these big movers. These are the ones that when I went back and studied literally thousands of trades that I had made over the years, I found that it was these big trends that I needed to have more exposure to. And frankly, if you talk to any hedge fund manager worth their salt, they're going to tell you that they are in the game to find the few big trends a year that are going to basically carry their performance. That they know that their goal is to not get hurt too much when they're not right, and when they are right, is their job is to milk those trends and to get the most out of them. So we're going to show you how to do that here tonight with several key indicators within the MetaStock platform. Now, we talk about big trends in MetaStock, and this is what we call the Big Trends Toolkit, and it is a tremendous platform. We spent a lot of time with the MetaStock programmers and a lot of time with our staff going through and really defining out a lot of different indicators. You can actually see here it's a lot to pack onto one chart, but basically you can see here that these 14 indicators, including some of the ones we're going to talk about tonight, like acceleration bands, a new approach to percent R, the efficiency ratio, various techniques. We're only going to scratch the surface tonight. There's only so much I can pack into an hour within 18 years of experience, but we're going to focus you on the best of the best situations here tonight. And so this really gives you the ability to go not only plot these indicators, but as those of you that are familiar with MetaStock know that some of these tools up here, like the binoculars, allow you to run explorations. The expert advisor allows you to actually see what I would be saying about any given stock based on its current status, buy, sell, or do nothing, which, that's part of the game. Sometimes you got to know when not to trade as well. And these indicators will tell you when to be in for the bigger trend and when to get out and move on. A lot of this game is about opportunity costs. You've got to rotate your capital when it's not moving on into something else. You cannot get locked into a view thinking that a stock has to fall or has to rise. The reality is the stock and the markets are going to do what they're going to do. Our job is to get in alignment with those moves. So one of the first tools that I developed that I gained some notoriety for is something that I developed back in the 90s called acceleration bands. I'm sure a lot of you have heard of the John Bollinger's invention called Bollinger Bands, and I think there's a lot to these this bands, but this is a different take on Bollinger Bands, a different way to use bands around the moving average. Our whole goal. By the way, how many of you, just out of curiosity, like to trade options? If there's a certain vehicle you like to trade, just curious, how many would say options or stocks or futures? Write in what your main vehicle you like to trade is. I'm just kind of curious what the general bias is. We're getting options 3 times, ETFs, option stocks, CFDs, which is in Canada, Forex, options, Forex, stocks, options, futures, and Forex. Bill's got them all covered. Hal says the minis, stocks, ETFs. So there's a good mix there. Stocks. So yeah, and this can be used across any of those vehicles and more. Basically, if it's got any kind of trend, if it's got any kind of potential to move more than just sideways, we're going to be able to spot when those trends are happening. When it is sideways, we're going to be able to say, here's either how you can stay away from it, or if you're stuck in a longer term, say, investment and you want to cash flow it, then you should look into options, because options are not just for speculators anymore. Options can be used to cash flow relatively flat, choppy stocks, or give you protection on stocks like these imploding financial stocks here in the U.S., which we're going to talk about here as we go through tonight's presentation. So what are we looking at here? Well, obviously, if I'm an options trader and I'm looking to catch a major move, I want acceleration. I want something that's going to have the potential to really speed up. If you think about your typical curves, usually people think of a linear curve in the market, and you think, okay, you want something that's going to be moving up. I'm not a very good artist, so you're going to have to pardon me. Let me see if I can get a better drawing here. You're going to want something that's going up at some kind of a nice steady rate, you think, right? But in fact, what I want is something that starts at that same rate, but you notice it'll start to accelerate. It'll start to go up at a faster and faster rate, and that's what we call acceleration. Why is that important? Because over that same time period, I will have made a bigger gain in the stock that's accelerating than in the stock that's going up at that slow, steady, linear rate. And the faster I can make that gain with options, the better. Am I always going to be right? Of course not. I'm going to have times that I'm not right, and I've got to have a way to manage my risk so that when it's not doing what it's supposed to be doing, I can move that capital out of that position and move on to another fresher idea that has a better chance to fit that acceleration profile. So like a lot of you, when I started trading with moving averages. I found that moving averages did do a good job at defining the general trend, but one thing I noticed after literally just thousands of examples was the best stocks back in the early 90s. It was stocks like Cisco Systems, Microsoft, Amgen, Home Depot, International Game Technology. The best stocks never came back to test the same moving averages. It was almost like that they were going parabolic. You weren't going to get another chance as they took off of the 50-day, then they were holding the 20-day, then they were holding the 10-day, then they were holding the 5-day. They're going faster and faster and faster until they finally shoot back down. So what I did was I started studying the idea of adaptive bands, and Bollinger Bands were the first place I looked. I think John Bollinger had a great idea where he said, you're looking at the standard deviation plotted around a moving average. So if you're looking at a 20-day moving average, Bollinger would say 2 deviations around there should encompass about 95% of the price action in between those bands. Well, guess what? What I found was that Bollinger Bands are very useful for stocks that have a lot of volatility but not a lot of direction, that they will adapt very quickly. But the problem is that they adapt too quickly when you get a stock that really wants to trend, really wants to take off. And I needed something that's going to stay with that trend longer. So that's when I came up with the idea of acceleration bands, because they're a little slower to react than Bollinger Bands, but they still do the same function. They're plotted around a moving average, typically a 20-day moving average, but we've got some other settings through the Big Trends toolkit that you can also add in for not just short-term, but also intermediate-term filtering to find the best of the best trends, both short-term and longer-term. And they still should encompass 95% of the price action. So with that theme in mind, if they encompass and hold in place as support and resistance 95% of the action, do you think I want to trade them inside the bands? No, actually, I want to trade them outside the bands. And one of the reasons I wanted to give you an updated presentation straight through today's close off the MetaStock software is to talk about one of my favorite stocks lately, Fannie Mae, Federal National Mortgage Association. FNM is the symbol. Anybody trading Fannie Mae out of curiosity right now? Just curious if anybody's enjoying that one. Most people are saying no. We've got a couple yeses. I hope for your sake, those that say yes, you're doing as I'm doing and trading the downside, because it's been a beautiful move to the downside. Well, what do you have here on this chart? For those that haven't seen acceleration bands before, let me actually just tell you what we're looking at here. Let me change my colors around here a little bit. And so our middle band, nothing fancy about the middle band. That's something that you can get on any chart. One second. On any chart, and that's just your 20-day simple moving average. You, me, and your brother can figure that one out, right? I mean, that's a basic moving average right there in the middle band. But what you see around it is we've got on the upside, you can see we've got the outer band is a 20-day upper acceleration band. Get my text tool to work here. So this is the 20-day upper acceleration band. And down below, you can see we've got our lower 20-day band. So there's your lower band. You can see it gradually adjusting around the trend in the stock. So here's your 20-day lower acceleration band. And so the idea here is that when it's stuck in between these bands, do you think that I want to trade when it's stuck in between those bands? Heck no. You can see one close even doesn't count. I've got to get 2 closes outside there. You can see we had this long kind of a triangle, I would call it, just a consolidating period there between the March bottom for the market and really before the stock finally broke down again back in early June. If you think about that, what would we call that? Would we call that a volatility expansion phase or a volatility contraction phase? That would be volatility contraction. You do not want to be buying options through that kind of a phase. In fact, if anything, you'd want to be selling them because they're going to be contracting. In contrast, though, I don't like to sell them because I want to save my focus for when they really start to break down and really start to break to the in this case, the downside. You can see this last move here. The last time we got an acceleration signal happened right at $20. Anybody know where Fannie Mae closed today? It actually, there was hopes that the government was going to bail them out, and therefore the stock rallied big this morning on the open. It went from 10 to 13.5 on the open, but it closed. You see this red candle. It closed back under 10 at $9 and I believe it's 57 cents. And so what we're looking at here is a situation in which we're seeing this clear breakdown, and we're seeing big move. You've already had the stock cut in half, and literally look at how short of a time period that is. If we were counting out the days since that last sell, we've had 1, 2, 3, 4, 5, 6, 7. Today was the 8th day. In 8 days, we've lost 50% of the value. The stock's gone from 20 to under 10. You can see actually it opened yesterday morning at about 6.5. So it actually had lost about 2/3 of its value at the lows in about 7 days. So yeah, we closed at 9.73. Thanks, Andy. So lost half of its value in 7 days. Compare that to the move between March and early June, and you see in 3 months it basically went nowhere. It went sideways, barely lower, from between 30 and 25. Who wants to fiddle with those tiny little moves when you can get these bigger accelerations? You can see the other big move that happened on this chart was where we had the sell signal happening back here at $55 back in November of last year, and the stock dropped all the way from, you can see the MetaStock helps us pick up. We've got our sell signal there, and it picks it up from 55 all the way to 30, again, in an incredibly short period of time. From that sell signal happens there back at the beginning of November, and to about right after Thanksgiving, you went from 55 to under $30, about 28. Again, about a 50% haircut. In this case, it took a little bit longer, but it was also a bigger point move, but basically that move took about 3 weeks. Well, that's where you get big potential in options. And you can see there was another sell here that actually was a signal that did not work. We had a signal down where we dropped from about 25 down to about 20, and then bam, it snapped up here, and you would actually have had a loss on that trade. So they are not perfect. Every once in a while, you will see situations in which you can see a big snap back into the bands before you close out. Our rule is to wait for the close so we don't get faked out by that particular scenario. We've actually added some tweaks within the Big Trends toolkit where not only does it have to break back into the band, but it needs to do something else, which I'm not going to give away because I can't give it all away to you here. You're going to have to, the toolkit's only, it's a very small cost relative to the money you make on trades or lose on trades, in this case, making on trades. What's the other thing I love about this indicator? The other thing I love about this indicator, it's got to get at least 2 closes in a row outside the bands. You see, we had 1 close outside the band, but it did not have a second one. It tried, but didn't get above there. You can see it tried to get above there back on the left side of the chart, didn't happen. The whole way down here, has it ever gotten above that upper band there? Not even close. So will this allow you to get bullish on Fannie Mae here? Absolutely not. That's one of the things that kills a lot of traders. Traders who like to fight the trend, who say there's value in Fannie Mae at $10. Hey, if there is value at Fannie Mae at $10, more power to you, and you may well be right. You may and I've got a Bear Stearns chart up later to show you an example of every once in a while, a blind squirrel will catch a nut and basically find a nut and basically manage to make a little money on a snap back up. And Rick has a perfect example of the kind of mentality that we are constantly seeking to change within our coaching program. And I'm going to pick on you a little bit, Rick, but it's for your own benefit here. Rick says, well, it can only go down 10 more points from 10 to nothing, so maybe it's a good long here, question mark. My world, Rick, and the world of any professional money manager is that a move from 10 to 0 is still a 100% loss. If you use position sizing like I do, everything is about what is my percentage risk. It's not about how many points you can lose. Yes, it was up here in the 70 area, and now it's at 10, so it's lost 60 of those 70 points. But the idea is that we are looking at a situation in which we have a cost on our capital, and if it goes from 10 to 5, that's a 50% loss. If it goes from 10 to 0, that's a 100% loss. Nick also says another perspective he has is think of it as a straight long-term call option. You're buying the stock at 10, could go to 0, but it could come back to 20, 30, or more. Who knows? Odds are that when these stocks have this kind of pain, usually the outcome is something like what you saw coming back late last year. You may get a bounce, and if you look at this whole period here, I'll highlight it in yellow just to kind of show you what you're probably, in your best case scenario, what you're probably looking at is this kind of a move, where when you net it all out, you've gone nowhere over the course of the next few months. That's why I don't think of it as a long-term call option to buy cheap stock that's depressed or distressed, but rather I think of it as throwing money down a tube, throwing money down the hole that basically I've got so many better opportunities for this capital than sitting here hoping that this thing's going to come out. Tommy says, why didn't I tell him this when he bought Thornburg Mortgage? TMA was a symbol on that one. Oh, I wish you'd been following our service, Tommy. You'd have seen that TMA was one of our classic bear shorts. It was just a beautiful acceleration down. And so that's what you're looking for. So you literally have to change the way you see, quote unquote, value buying and instead say, these strong trends is where you're going to make a lot of money in put options on the downside. So you can see where's the best moves on this chart. Bam, that first move to the downside. That next move to the downside didn't last. We were faked out on that one. But the next move to the downside, more than a 50% drop here from the signal at 20 to the low yesterday morning. I started to unwind some of my bear bets yesterday morning. I added a few more this morning on the gap up, and it's shot right back down. I still think Fannie is headed a little bit lower. This also, by the way, for option traders is July expiration week. I love doing strategies involving short-term options, buying and selling, doing some spreads. Too in-depth to get into here. If you're interested in that, ask us in our coaching program. We just started up our options master's course just this week. So if you're interested in learning about all the different ways you can use spreads, Fannie Mae's options in July, both the call and the put options, are running about a 300% implied volatility. Not to blow anybody's mind on technicals, but that is saying that this stock is going to be incredibly volatile. But in fact, based on my strategies, I'm set basically to, if the stock just stabilizes here, basically in a range between about anywhere under about $11, I'll be making about 30% in a week, which if you annualize that out is 1,500% annualized. If I can, of course, I'm not doing that on my capital, but the idea is if I could do that across a whole basket of securities, these are the ideal scenarios for option spread trades. Both short-term and longer-term ideas can work here, but I really like the short-term ideas. Okay, how about on the other side? I know a lot of you know about the oil trend. This is one of the best ways to follow what's happening with oil prices, and it's this ETF, USO. Ticker symbol USO stands for U.S. oil, and it's basically a proxy for oil. It doesn't match the barrel change per day, but you can see we finished up here around 117. But anybody follow U.S. oil or any of the other oil ETFs? Yeah, a lot of you are, and that's good. You should be, because obviously this is having a very negative effect on our stock market. The reality is that this is sapping consumer buying power. It's killing the retail sector. I have a friend who's a retail hedge fund manager, and he said basically he had to become an expert on where oil prices were headed because it was basically hurting traffic so much because of how high oil had gotten. So in a nutshell, what you see here is now the upside acceleration. It's funny, back when I started Big Trends back in '99, of course, we were near the tail end of the tech bubble. I wrote a book called Big Trends in Trading. A lot of my examples were about the techs and a lot of the money that I'd made in the techs to allow me to found my company. And people said, oh, those are great examples, Price, but we'll never see that again in our lifetime. We'll never see a bubble like that again in our lifetime. And I said, my answer was not in Cisco, not in Amazon, but that we will. It's just that the names will change. And that's something that people get hung up on. Everybody gets bought into some kind of fundamental story why they've got to own Microsoft, why they've got to own Cisco, why they've got to own XYZ.com. And the reality is that, I trade these basically when the signals are valid. When the signals are done, I get the heck out and I move on because it's about a rotation of capital. Look at your sweet spots that the MetaStock Big Trends Toolkit allows you to spot. Back in February, March this year, when oil prices were going up, we had about a 20% pop in oil there. We had another 10% pop there in mid to late April. Got another nice pop most of the month of May. And right now we've been in no man's land. There's no signal here. Even though oil's moved up, the bottom line is that this is really the sweet spot. Right now, it's acting as resistance. You can see we got resistance on that big shot up in early June. We just hit that resistance again, and we haven't followed through there. Fernando asked, what's the derivation that these bands used from this average? Well, once you buy the software, Fernando, I've made it to where all of my indicators are open source. Once you buy the software, you can actually see all the indicators right in front of you. Obviously, I can't give it away, but basically it's all right there for you. So I didn't hide anything from you. Once you have the software, you'll be able to open this up and be able to see each of these indicators and exactly what makes up the formulas. But you can see where are the sweet spots here. They're those highlighted yellow areas. You could say, yes, I've missed some of this last run. Now, I've had some other stocks that are oil stocks, and if you looked at the basic trend, you'd say, okay, well, it's moving up at a decent rate there. But if you measure the angle of the ascent that was happening before, look at which one's the steeper ascent, which one's the greater acceleration. It's those acceleration periods. We've slowed a little bit here, and the reality is that's what I am keyed on, is that in the meantime, like I've traded some other oil stocks or derivative type of plays, like this whole shale play, the whole oil shale stocks, coal stocks. There's a lot of other areas that have been doing better than oil recently, and it's because of that alternative investment angle. So this is what we're looking for. Tommy asks, is this chart from the expert advisor, or did I add comments to the indicators? I add comments to each of the indicators, Tommy, so that when it says to buy, it says exactly what you're doing. And Thomas says he just bought my DVD course. Does that have anything to do with this tool? And that's a big yes, Thomas. You'll, in my DVD course, which if you're interested in that, call our 800 Big Trends line. But bottom line is that that goes through acceleration bands in great depth. The whole underpinnings, the formula, et cetera, there too. So it's available in both the MetaStock Big Trends Toolkit and through the DVD course. Okay. So with that in mind, it gives you some example of how this works. Okay. How about one more example of one that's not in a mode? A lot of people like to say, well, gee, they like to trade Google all the time. They say, well, Google moves so much that basically they figure they can always get some kind of action out of Google. By the way, Google has earnings coming out, I believe, right before the expiration. And that is always a hairy day right before the expiration when you've got Google's earnings the night before the expiration. Steven says, by the way, that if I'm exiting on the bar after the exit, it looks like I'm giving back most of the gain. Well, you can see in the case of Google, I'm mostly interested in the phase that's happening outside of the band. So the sweetest spot for me as an option trader is a spot outside the bands, which you can see is where Google came out with earnings, and then the second day in a row above the bands told me this thing's going to keep going, and it did run from about 540 up to about a little over 600. That was the sweetest period. Yes, by the time this final exit came here, it did give back some gains if you're waiting all the way, if you're a little longer term trader. I use this to kind of first get on the right side of the what I would call the position trading trend, and then I'll work down even into hourly charts for some swing trading. So that's really what I'm looking for, is catching not just the bigger trend, but also the swing trading sweet spots. So I look at multiple time frames. This is just a starting point. This is just to sort of wet your whistle. But the point I wanted to make on this chart, you can see there was one also great period on the downside back in this area where we caught that last decline on Google. And it's the thing, you don't have to catch the whole move. You say, well, you're missing some moves. I don't have to catch the whole moves. all I need is just to catch one sweet spot that's got that kind of leverage, and that's what we're looking for here. Here we are looking at the daily charts, and so Rick asked, might you lose on volatility if you sell an option inside the band? Generally, you'd like to sell an option inside the band instead of buying an option. Some people I know will try to buy right at the lower band, and sometimes that works. Sometimes it snaps back, but sometimes it doesn't. Generally speaking, again, remember your slopes. Remember how sloped we're talking about here. If I'm just drawing a black line through my slope, the best part of that trend there was when we're outside that band or when we're below this lower band. If we're stuck in the middle of this band, you can see we've had a downtrend and it's sloped about like this. That basically you can see it's working its way lower, but it's not doing so in as much of an accelerated way as it was back through this last big quick decline. So I want that bigger acceleration to the downside. That's where you're going to get more bang for your buck on a day-to-day basis, especially if you trade more volatile stocks. You're going to be in a situation in which you want to be capturing that and then moving on. So I don't want to be sitting there waiting, because the decay on Google over those month and a half that it's been grinding down is just simply too dramatic. Yes, could it drop a little more to the lower band right now, about 510? Sure it could, but that's not really the big downside play. The financials, for example, have been much better. Okay. With that in mind, we say if you're learning options and you're just starting to get into options, I tend to be one of those guys that's relatively conservative, that says even on my own money, even after trading a long time, I like to use in-the-money options as a buyer to substitute for the stock. I don't like to speculate and buy cheapy options. Why? Because in my experience, when you buy cheapy options, you usually have to pay a bunch of time value. I want to get rid of as much of that time value as I can and focus instead on what we call the intrinsic value. The intrinsic value is really what, if nothing happens, what portion do you have that can't be hurt if nothing happens in the stock? For example, if you're going to sell short 100 XYZ shares, say at a price of $56.60, well, then your broker's usually going to require you to tie up at least half of that, probably several $1,000s in margin money. Well, here we are mid-July. What if instead I said I want to buy an August 60 put? That gives me the right, not the obligation, just a right to control the stock at a fixed price of $60. I could sell it at 60 effectively if I chose to do that. What is the right to sell the stock at 60 worth, that put option, when the stock is down at $56.60? Does anybody know? Let's see who gets it first. It's not 440. It's close. There you go. Kiwi and Rick are on it. It's 340. And Nick, you too. Yeah, 340 is the correct answer. Sash, you're right there as well. So why 340? Because in theory, I could go in the open market, exercise this option, sell it at a price of 60, and come back in and buy it at the current price of $56.60. That difference is 340. So you could do that, and you would lock in 340. That's why we call it the intrinsic value. It's intrinsically worth that difference right now of 340. Now, why would you not do that right now? Well, because there's time left on it, and the option's actually trading in the options market at 470. Why am I getting another 130 over my intrinsic value of 340? Why am I getting 470 for the option now? What's that other 130 called? Anybody know? That's right, Nick and Sash and Shannon. It's time value. Some people call it extrinsic value, but that's right. It's time value. And so extrinsic meaning not intrinsic, but I like to call it time value because that's what you're paying for. That other 130 is time. So for me, everything I do, I calculate in percentage terms. So for me, in a percentage basis, we're looking at 130 out of the 470 as what? That's about 28% of the option's value. 130 over 470 is time. That means the intrinsic value is 340 over 470. That is what we call the intrinsic value. That's 72% of the option is intrinsic value. My basic rule of thumb when I'm trading in-the-money options as a core strategy is I want to choose an option that's got at least 2/3 of its total premium as intrinsic value, at least. And frankly, the closer I get to expiration, like right now, trading July expiration with now 4 days to go, I'm dealing with 90% or more intrinsic. But if I'm looking a month or more out, 2/3 intrinsic is a pretty good ratio. No more than 1/3 of the option's value time. That means that if nothing happens, you're only risking the time portion. Now, if this stock drops, like I think it will, from the current price of 56 and change down to 50 before mid-August, well, what am I going to make? Well, the short stock would gain $660 down to $50. So that's not a bad little return. But what's the 60 strike put worth when the stock drops down to 50? Does anybody know? Just intrinsically, it's got to be worth what? You could exercise it, sell the stock at 60, buy it back at 50, and you would exactly make the 10-point difference. So you're making and that's 10 gross. You paid $470 for it, so that means on a gross basis, just looking at the intrinsic value, we're looking at a situation here in which the in the money would gain 10 minus the 470 means 530 gross, again before commissions, to factor your commission into. Well, and Nick says, what about your 130 time value? Well, what happens is the more in the money you get, the more your time value goes away, and it becomes more and more about intrinsic value. So when you go that deep in the money, you're going to probably lose the bulk. You might have a little bit of time value left, but even if it happened right away, you're going to lose a chunk of time value. The option that has the most time value is the at-the-money option. The deeper in the money it goes, it loses time value. It becomes more about intrinsic. Okay. So basically, we're in a situation here in which we're looking at, about a almost 10 to 1, 9.5 to 1 leverage on the option compared to the stock. That's why I call it bigtrends.com, folks, because I'm not looking to scalp 10 or 20 cent moves. Somebody said, well, why don't you just buy an option and sell it when you make 10 cents? Well, that's crazy because A, you're risking more than 10 cents probably, and B, you've got commission costs. And so from that's the basic thought I would say is that you'd want to really be in a situation in which you're going to really make sure that you can ride when you're right, and when you're wrong, get out quicker. So that's what we teach in our Big Trends coaching program is how to get out quicker when you're not right, and when you're right, really ride it longer. Now, one of the indicators that I use in a very different way, and I'm sure a lot of you have heard of Williams% R, but probably not the way that I use it if you haven't heard me before. Williams% R, Larry Williams developed this indicator. It's very similar to stochastics, and it looks to measure what we call overbought or oversold levels. You've heard these terms before. Overbought implies what? If you heard the word overbought, does that imply that you should probably buy it or sell it? That's right, Nick. It would imply you should sell it because overbought implies it's too extended. And so that's the basic thinking. In contrast, of course, if you hear the term oversold, it implies, it's too washed out. You should probably buy it if it's oversold. Well, I'm going to try to break that down for you and blow apart that myth because it's cost traders literally millions, if not billions of dollars, not knowing what's a true overbought or a true super strong trend. You'll see when you first plot %R, the traditional scale is from a peak of 0 down to a low of minus 100. So I don't like that scale. I don't think it's intuitively as sensible. So I prefer to change my settings to a scale from 0 to plus 100. You'll see me use both here tonight so you can see how both look. But the other thing that my testing turned up was that most people default to a 10 or 14 bar setting. I found that the 30 bar setting actually works even better, at least for what I'm looking for, the very strong trends and how to ride those trends. So what are we looking for here? Without further ado, one of my key rules, and again, these are the kind of rules I go through in my DVD course. You get this through the MetaStock Toolkit already pre-programmed, But what we're looking for is something very unconventional, very different from what the rest of the crowd expects. In this case, what we're looking for is when it goes overbought. Well, think about this for a second. If it hits a reading over the 80th percentile, so on a 0 to 100 scale, it's going to be 81 or higher, basically above 80. Well, if it is indeed the top of the trading range, would you expect it to keep on going above that bar's high when it first went overbought? I know I wouldn't. I know that basically at that point it should stop. So I started studying a lot of these charts, and before I put them through the testing, just studying them and noticing that when you get these rare situations where you get a close, not an intraday move, but a close above that first bar's high, that is telling you that something unusual is happening. That in fact, I call this bull confirmation, that the bull trend is kicking off. And so you're really getting a super strong reading from the stock. It wants to go even higher when it's not supposed to. Meanwhile, you have all these other people that are misusing stochastics and %R and either getting out of it and selling it and thinking, it should come back down, and then being forced to chase back into it later as it keeps going up. Or you've got the super aggressive types who are shorting it when it goes overbought, and then they're getting fried and they're having to buy it back and further push it up. So you have all kinds of people that will come back into this one later to further add to the buying power. That's the bull side confirmation, the first, what I call bullish confirmation. And so this is the, on a scale from 0 to 100, this is at 80% or higher, the top 20 percentile. Thomas asked, do I mean minus 80? No, if you're looking at a minus scale, if you're looking at this 0 to minus 100 scale, then what would be the top 20% of readings? It would be minus 20 in that scale. So that's for the bull trend. Now, so that's why it confuses a lot of people, but that's why I like the 0 to plus 100 scale. It's a percentile scale. It makes more intuitive sense. Okay, in contrast, if you get a bear trend, then we're saying, okay, if it goes oversold, then if we get a reading under the 20 threshold, in the bottom 20 percentile, which again, on a 0 to 100 scale is at 19 or less, if you're looking at the old Williams scale from 0 to minus 100, now you're talking about under minus 80 would be the bottom 20% of readings. So remember that, just the top 20% or bottom 20% of readings, whatever scale you use, you're looking for those top tier or bottom tier names. Most of the financial stocks fall in this profile in the bottom 20%. Because if that low hits and it should be oversold there, well then what does it mean if it closes below that low? A close below that low, and I'm talking mainly on a daily chart here, but you can use this on all time frames. Works on any time frame. You just got to wait for the close of that given bar. Actually, the close below there tells me watch out below. That's a bear confirmation. So let's look at a couple of examples. Here we've got an older example. This is Mastercard, ticker symbol MA. I'll show you the current Mastercard chart in a minute. This is actually from last year. And this was one of my better stocks last year. You know, the credit card company, when they came out, just kept on rolling much, much higher. Well, what you notice, let me change my colors around a little bit here, make it kind of a pinkish color. So when it gaps up here, we're getting our first bullish setup bar on the gap up. I'm not going bullish there, up there at 130 on that high when I draw that line across there in early May. But I'm saying it's got to close above that first high. That was around 130. We can see the very next bar I'm going to put a circle on. It closes above there at about $135. That's what we call bull confirmed on that circle there. Now, that's a first spot you can start to build a position if you like. I find in my own, especially options-oriented work, is that once I'm in a bullish trend, I like to buy dips. I like to buy what I call retests. What's a retest? Well, a retest is when it looks like it's coming back out of that oversold threshold. Now we're using the traditional scale here. You can see this is the minus 20 overbought threshold. Notice we're not even dealing with the minus 80 oversold threshold here. It's just looking at the top tier, the best part. But that retest back on May 14th is what I call a bull reentry point. It's a low-risk entry. If it had closed below that bar's low, the May 14th low, remember that's a close in a future bar, not an intraday trade, then a close below there would have gotten me out. But instead, it keeps testing for 3 bars, having what I call a bend but don't break, where it tests, but then it closes back above that key support about 135. That's telling me that it's holding my key support. So I actually am willing to put on trades right into the teeth of those pullbacks. No matter how nasty one candle might look, one bar does not make a downtrend. You can see in this case that it went from 135 up to 155 for a big score. That was a very, very nice, about a 200% gainer. The next, let's say you missed that move. Anybody ever been watching a move and they know they should have put a trade on, and then for some inexplicable reason you just didn't pull the trigger and you didn't put the trade on, and then you watched it go up with you on the sidelines? Anybody ever had that happen before in their trading? Andy says always. Most of you say yes. I mean, everybody's had that happen. Steve says, story of my life. And we've all been there, right? Well, the beauty of this retest method is that it actually gives you multiple reentry points. So that when a trend is good, an uptrend in this case, look at the next time it comes back under the minus 20 threshold. The reason I like percent R better than stochastics, I used to use stochastics. Percent R gives me more of these retests. So this was a trade we actually made in our option shark service. Right there at that low point, I remember it well. The low of that bar was $138.10. I remember it like it was yesterday. Well, we put the trade on right there near the end of the day. Said it closed about 139. So it said if it closes under 138.10 in a future bar, we're getting out. Well, look at what happens the next morning. It's actually below there briefly. It actually trades down to 135 during the morning. The market was weak, but look at where it closed. It closed back up here at 143. I call that a bend but don't break. It's like the bears took a shot to break it down during the bar, but by the end of the bar, the bulls won the war. I like to say that a lot of battles are fought during the trading day, but the war is won at the close. So whatever time frame you trade, to me, the close is the most important. So Rick asked, did I get shook out? And my answer is absolutely not, because I told my clients in my Option Shark service, my subscribers, I said, look, you've got to wait for the close. You cannot panic like everybody else. If you do the same things that most other traders are doing, guess what kind of results you're going to get? The same below mediocre results that most traders are getting. You've got to do things in a different way. That's why my DVD course and everything we do through coaching really retrains you to really understand how to think the proper way, how not to think like the rest of the crowd, how to take advantage of the rest of the crowd's overreactions. So we tell people, look, you've got to hang with that trade. We stayed with it, ended up selling half of it at a double about 3 days later when there was a rumor that Kirk Kerkorian was going to buy a big stake in the company. Said, thank you very much. Let's take half of our profits there. Took another half at a triple up here when it shot up again the very next bar. And I left a little bit of money on the table. It ended up being a quadruple by the time it was over. I was okay with riding it through. Rick says no stops. Well, actually, our stops are only reset. Once you take half off of the double, you've got incredible flexibility. The next stop point is when it comes back down and gives you another retest. So now you tighten your stop right up off of this low. So you can see that's now tightened there. I don't tighten my stops every single day. As Nick notes, I had a free trade. That's exactly right. Once you take a double on half or more than a double on half, you've got all your risk capital out. You can be much, much more aggressive riding the rest. This next retest that comes in, you can see it actually does violate just under that low. The very next bar, it closes. You can barely see it here, but it closed 20 cents below there. The low was 161.70 or so, and it closed at 161.50. I don't care if it violates by a penny at the close or by 10 cents or by 20 cents. Any violation, even by a penny, is enough to say, bye-bye, it's time to go. Thank you very much. It's been a nice ride. Now what happens? Now it starts to bump around. Then it starts to try to jump up again. You see how it tries to jump up again, but it doesn't follow through above those highs? Forget about it. You're not interested. You can see then it rolls over without ever confirming, and we say, no thank you. We avoid that fake out. There's a huge difference to me between a true breakout and what I call a fake out. And that's why I require the confirmation point. Not just the first time it goes over the overbought threshold, But the follow through, the sign that prove it to me, stock, show me you really want to move. If you prove it to me, I'm happy to participate. If you don't prove it to me, I think I'll hold my capital and go play somewhere else. So that's really the nature of the game. It keeps you out of a lot of trouble. Does it avoid every whipsaw? No, you're going to get whipsawed every once in a while, but the key is that you're gonna miss a lot of the other ones. Now in this chart, came out a little fuzzy here. That's my fault. It's not MetaStock's fault. I just didn't put the resolution high enough. But you can see the stock. This was last August. Stock was just dead money kind of in this area. You can see just not much happening in there. A lot of resistance. But what's interesting is that notice the breakout that actually happens here. Let me actually take those other lines off the chart. The breakout actually happens right off of that high, and the very next bar, it barely confirms, but it is bull confirmed right when it broke out above that level and kept going up. Now, we already had some bullish exposure. That was when the Fed started aggressively easing rates last September. But what's interesting is that once it came back and retested, look at this retest. When it comes back under, bam, on that big slam down there, right on the dotted line, right on, that was the 24th of September. That low was just under 140. It was like 139, trying to remember it, 139.65, I believe. We told people basically right around 140 should be a great place to buy. So guess what we were doing the very next day? We were saying, thank you very much, Mr. Market, testing right into that same area, 140. We were buying, and then bam, it had this big snap up. Now, if you were using just support and resistance lines, I guarantee you would have missed this trade because you said, well, the support's way down here, and then there's obvious resistance happening all through this area here. You can just see all that resistance, right? Well, you would have said, well, it's just dropping back within the trading range. But the structure of the chart that we see here had completely changed. And so that was another one where we were able to score the double on the first half. That's just a rule with me. On my option chart service, I will take the double in the first half right there, and then we ended up taking 268% up at the next key target area. So bottom line is that these are ways in which I trade these situations. What about the current outlook for Mastercard? Well, as Jake alluded to, we've actually added what we call version 2 of the Big Trends Toolkit, in which we added other scans. We've already got some pre-programmed scans that are worth their weight in gold to me, and I think they will be to you as well, but we've added even more. We added what we call the retest scan. What's the retest scan means? It means that when you see Mastercard go bull confirmed, and then you see a retest like what you saw back here in April, that retest says, there's your buy point. You run your scan that night, and it says, just got your retest on Mastercard. Is that valuable to know you just got a retest on Mastercard? Right after it's been going sideways and it comes back in to give you that, look at what it does after that. Slams up. Huge opportunity. So that's what we're looking for here. And so that's our stop. If it closes under that retest low from that bar, we're going to get out there. So that's as Rick says, sweet. That's exactly what we're looking for, Rick, are these sweet kind of entry points. So you can see it then gives another retest coming in, as you see. And here's an example where it doesn't work. Gives another retest coming in right here, and it violates the very next day, and it loses about a half point off of that last retest. This is the ultimate secret to trading, folks. Lose small and win much bigger. If I could pull it down any simpler, I would. But it's that simple. When you lose, lose small. When you win, be willing to win bigger. Be willing to ride for the bigger gains. If you can do that, you're going to be a much, much more profitable trader. And frankly, the Big Trends Toolkit gives you that ability. You see how from there, look at what just happened here recently. We just had the breakdown in Mastercard. It's since violated that and broken down further. So it's bear confirmed in this area. But look at what this system's saying is wait and show me a retest. What's a retest on the bearish side? When it shoots back above our oversold boundary, which is the 20 or higher, 21 or higher level. And you can see there's where it's picking it up. So that level right there is now our new stop. If it our closing stop, by the way. If it closes above that level, we've got to get out. And in this case, this is one in which, it can bump around for a week or so while you're waiting for that level to be, ultimately borne out. So when I'm looking at that, and I have no hesitation saying the indicator is what tells the tale. The indicator says on that day, that was July the 8th. This is how exact we'll get through my coaching and the software will allow you to get. July the 8th, the high of Mastercard was 264.99. So a penny under the 265 level. Today, it hits 263.39. I'm sorry, 263.37. But we're still using this last retest level here, and you can see that 264.99, we're close to it, but it reversed and closed down at 257. So it's still holding in there. I still expect more downside for Mastercard. Back last year and even earlier this year, everybody was telling me, isn't the subprime crisis and the banking crisis, doesn't that have to hit Mastercard? And I said, yeah, it may hit Mastercard down the line. But back then in 07, and even as you can see in April and May of 08, my charts were saying the sweet spot is still to the upside. All that skepticism was giving you more opportunity upside. Guess what's happening now? Now you're seeing the conversion. Now the risk is to the downside. Maybe now people will be concerned about greater delinquencies. I can fundamentalize with you all night long if you want to have philosophical debates, but if you want to make money, in my opinion, you trade the technicals and you follow the low-risk entries and you go back to the basic rule of if I'm wrong on MasterCard, I'm going to lose small on this bear trade. If I'm right and it flips down, who knows how low it can go? I don't. Nobody knows ultimately how low these things can go. That's why I take part of my money off when I hit a double, and I ride the rest based on the indicators that are available to you in MetaStock. So just summing up that double rule, when you give yourself a chance to stay with a winner, you only want to take half of your profit at 100% or more. So if it gaps to more than 100%, then take whatever it is. If it's 100% or more, lock down half. Rick says, do I consider the overall market? It's way oversold. There's no doubt about it. It's been very bearish. I've got a DIA chart for you later on where it shows you we've been bearish on the market since June 9th. It's been over a month. But am I going to pick a bottom based on a really nasty trend that's still in place? Heck no. I've got to stay with that. Yeah, I've lightened up, but I've got to say, look, the trend is still bearish until we get that clear break of that downtrend here. Then we'll probably go through a little bit of a chop, and then we'll probably get a recovery. But it's who's to say, who's to pick when it actually turns. I guarantee you that all the big boys, all of them think they know how to do it, but you've seen more geniuses and rocket scientists go belly up trying to leverage up and pick that, and that's exactly what you look for. Steve says, what about the Budweiser announcement? Well, hopefully they're not going to raise the price of Budweiser. That's all I have to say about that. Prices are going up everywhere else. It wouldn't surprise me if they did it. That deal, frankly, that's a foreign company coming over buying very cheap with very cheap currency on their side, getting basically a great deal. Even they even threw in a few extra billion, and just to go ahead and get the deal done, and that was probably like chump change for them because of the currency that is killing us on the dollar, killing your and my purchasing power here in the U.S. relative to those overseas who are getting much greater buys. It's definitely time to come over here to visit. It's not time to go overseas to vacation or visit if you're in the U.S. But anyway, bottom line is the 100% rule. What it does is it allows me to release the fear, and allows you to release the fear that everybody has of really giving back their profits. Everybody has that as one of their fundamental 4 fears. And the reality here is that, and I'm at my hour point, so I apologize. I'm going to go just a little bit over, but I get going, and it's hard to get me to stop. I'm like the Energizer Bunny, so bear with me. But basically, I'll try not to keep you awake all night here, Jake. But basically, the principle is that you get your original risk capital back, even if the other half went to nothing. It actually, would guarantee you at least a break even. Of course, we don't want to let the other half go to nothing. So what do we do with the other half? Ride the other half position until it does one of a few things. If it gives back half of its gains from its peak gain, then you have a situation in which you would sell it because it's just giving back too much of its maximum gain. Or if it doubles once again, if you've got enough contracts, usually you got to have 4 or more contracts to do this. You can sell 2 at a double if you had 4 contracts to start. Sell 2 at a double and then sell another 1 at a double on a double, or a 300% gain. That's what we do in my Option Shark service. If you'd like to get a trial to my Option Shark service, just make a note of this 800 Big Trends number and give us a call tomorrow. We'd be happy to get you some information on that. But tonight I want to focus you on the power of the MetaStock software. This is just one of my rules that can help you in your own trading as well. Okay, so why do I have an old 2007 chart up at Bear Stearns, BSC? Well, because it shows you that because of the MetaStock software, I've been talking about Bear Stearns since last July. I was telling people that Bear Stearns is a relative underperformer within the brokerage stocks all the way back before the market topped in May and June and early July of last year. You can see it was dropping slowly from 160 to 135 or so. But where do we get our real breakdown point? It's when this blue line, when we finally broke down under that setup bar's low, 2 bars later, it gave the bear confirmed signal on the percent R. That was right at 130 bucks. I was in there liking on the 140 puts out in August. Had about a month ago. They were 10 points in the money. I paid 13 for them, so I was paying about 3 points out of the 13. Not quite 25%. But basically, so he had about a little over about 80% intrinsic and about 20% time. Then and I only did half the position because I was thinking we might get a retest. It gave a retest, and look at where it gave the retest. Right there in that red down there, that second one actually on the lower part of the chart. It gave the retest right there. And the very next morning, that retest was about 128. So that's where you can add to your position to get to a full position. The next morning after that, it tested above there briefly at 130. Does that mean that you should stop out because your closing stop is at 128? No, it means wait till the end of the day. It didn't violate that at the end of the day. In fact, it closed all the way down here at 121. So it actually was a great fake out for those people who don't know the closing stop rule. Went all the way from 121 down to under 100. You can see that same bar that hit 100, it actually retested right there, right back above that oversold threshold. So that was my new stop right around 115, and then bam, it closed me out the next bar at 118 on the remaining half of my position. I'd already had the chance to get out a half at a double, because remember, if you paid 13 for a 140 strike put, well, if it goes to 26, it's doubled, right? Well, 140 minus 26, that's 114. So on the way down, I already doubled half and was riding the rest. Now, the other point I make is that people say, well, geez, you missed a lot of this downtrend. It went from let me clear this. It went from 160, and by the time you got your signal, it was at 130. And my response to that is, I would rather not trade for those 2.5 months and then get in here for under 2 weeks and catch a much steeper slope from 130 down to 100. So I'm going to get much greater acceleration, much greater bang for my buck, much less time risk in my options, and then I'm going to get out and move on to the next trade. Okay, what about the next time we saw Bear Stearns this year kick into gear? Here's our chart this year from MetaStock again. I didn't bold my percent R as much as I should have, but you can see we got our first breakdown back at 90. It went from 90 down to about 75. Not a bad little first pop. You can see the next time we got to sell, it was inside the acceleration bands, which I don't really like it when it's inside the bands as much there. So that sell didn't interest me as much. But look at this last breakdown. It broke down, then it broke outside the acceleration bands. Look at where that happened. I remember it well. It was right at $70. We also came within literally just a fraction. It was like 19.99, right on that 20 level retest level as a low risk bear entry right there. We actually caught it in our Grand Slam service, and you can see the big pop to the downside. Now, right there, and we made a mistake. We got out a little too early for only a double in a couple of days. Thomas asked, can we look at Citibank? I don't think I have that one up here, Thomas, but we do that in our weekly coaching sessions. If you're interested in coaching where we look at all your positions, anything you want to look at within small groups, we can do that. Just give us a call. We have a few spots left in my final coaching group that just got started here in the last few weeks. But bottom line is, I had a friend call me, and he calls me right here, right at $30 on Bear Stearns that Friday, the 14th. Never forget it. Calls me the last 10 minutes of the trading day. Goes, Price, this is a great deal on Bear Stearns. Not only can I buy the stock cheap here at $30, you can see where this is going. It's going to get bad really fast, right? Not only can I buy the stock at $30, but it's a week from expiration. I can sell the March 30 calls with a week to go for $6. That gives me cushion from my $30 entry down to as low as 24. I can break even all the way down to 24. And I said, don't do it. And he said, oh, I already did. I just put my whole SEP IRA contribution into it. 1,000 shares, 30 grand. Well, you can see what happened. If the options are priced expensively, and by the way, like Nick said, back of the truck, it's cheap, just like Enron, and that's exactly right. We had a lot of people who said that with Enron all the way down from 20 to 15 to 10, even at 5. People were asking me, well, aren't you going to buy some Enron? It's just so cheap. It's the same principle. From 5 to 0 is still 100% loss. So don't think like everybody else that's going to cost you a lot of money. Now, so the doubly sad part of the story is then that over the weekend I see that what I thought was a typo when it said $2 a share. I thought it was $20 a share with a typo. Rick notes people like to go long. That's true, Rick, but that's why you have an opportunity to go short and profit from other people's inherent bias that's costing them money. It's not unpatriotic to be able to do both. In fact, I consider it very patriotic to you and your family to know how to profit on the downside as well as the upside. Amen, says Rick. So to me, the worst part of the story was that, and as Nick says, unlearn your baggage. That's what we're constantly reteaching in our coaching program, is the new way to think, not the way that you were mistakenly taught to think. It's not your fault. It's just time that you learn the right process. So what happened here is, and it opens, the offer's at 2, it opens and it's trading around 3.5. And my buddy goes, oh, well, okay, I made a mistake. I'm taking my hit. I'll take the 3.5 because it's going to get settled at 2, and I don't want to give up that extra 1.5. And I'm like, no, market's telling you that something's coming. It's too cheap. And Nick says now it's really cheap. It's too cheap. I'm not buying it at 3.5, but I'm certainly, if I owned it, I wouldn't be selling it at 3.5. It's probably going to bounce. And of course, a week later, it goes to 10, and my friend double kicks himself because he's pretty much botched it on all sides. But there's no way that I would buy that one on the gap down at 3.5. It's clearly below the acceleration bands. Yes, it went back to 10, but there's too many other spots. Actually, if you traded the 15-minute chart, the 15-minute chart gave a buy at 5 and got an exit at about 10.5. So it did double on the 15-minute chart. But that's not what we're keying on here. We're just looking at the daily. You can see oversold the whole way through here, and that's what you're looking for, is that's your speed to the downside. Okay. And I've clearly gone way past my threshold, but I got one more concept I want to share with you, and then I'll wrap it up and get it back over to Jake. This is another concept that we've plugged into the Big Trends toolkit, and I call it the idea of the efficiency ratio. That is, how efficient is the price action that you're paying for, whether you're buying an option or buying a stock or buying an E-mini or a Forex or whatever. Whatever you're trading, how steady and efficient is it? Because that can be real useful. If I said, not only are you going to buy a bullish position, but I'm going to ask you all just with a quick quiz, if you could buy not just a bullish position, but actually a call position in one of 2 stocks. A stock in red, let's say your typical tech stock, or say a slow-moving stock in white, say a utility stock. And I tell you 2 pieces of information before you answer. And so think about this for a second before you answer. Let's say that you know that both of these are going to start at the same point and they're going to end at the same point, but you can't predict every little squiggle on each. You just know they're both going to make it there from beginning to end. Same time frame, same stock price to begin, same stock price to end. Only other thing that's different is that market knows that red is a tech stock is going to be more volatile. They say that red's going to be twice as volatile as white you're going to buy an at-the-money option, say over the next 60 days, and this move takes 30 days, how many would want to buy the stock in white or calls on the stock in white or calls on the stock in red? Just type in a W or an R. I'm just curious how many say. So we got white, 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 red, 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 white, red, red, red. Couple more. Red. Last one, red. Okay. And so basically, we've gotten a pretty good mix. Started off strong on the whites, finished strong with the reds, and that's about typical. Usually, I'll see about half and half. Half of the people will say white, half of the people will say red. Those that say white tend to say, "Well, why do you say white?" You'll get answers like, "Well, it's steadier, it's more predictable. I sleep better at night." Anna, as one of my coaching students, notes that it's cheaper on the options, and that's actually the really big reason is that the options, remember, that you're paying for less volatility. That's right, Shannon and Mark and Anna. That basically you're paying half as much for the options. So as Mark notes, it costs less. It'll cost actually about half as much for white compared to red. So those that say red say, well, I want more volatility. That's what I've been taught, is that I want volatility. But actually, what you really want is trend. You really want trend at the least possible price. So if you're getting the same trend, but you're paying half as much for white's calls as you are for red, then you're actually getting twice your return on investment for white's calls. So you want the greater, steadier efficiency without the give back. You want white. And the other thing too, remember, if you follow moving averages, if I was just tracking some kind of basic moving average through here, well, there's probably going to be some points at which you're going to be risking getting stopped out. I'm not the best artist, but basically you can see there's a couple points on red that would take you underneath here, whereas white would keep you in the game. So red, actually, that churn, that ultra index, I call it, basically that creates some churn in your gut, and maybe even some churn in your stop outs if it's too volatile and has excess noise. So we don't want that noise. Noise is our enemy as traders. So that efficiency is something that we've set up now to track, and without going into great detail on the ranges, and we have a very complete workbook that comes with your Big Trends Toolkit that explains all this. But the efficiency ratio is in the top panel, and you can see when it really gets very, very efficient here, and you can see even when it's staying up above, this whole period here, it's very efficient. And if you look at, that was First Solar, that whole sweet spot there was where it was really nicely efficient. Had another great period of efficiency through here. You can see how the stock takes off and really rockets through that window. And this is the efficiency ratio, uses the same kind of retest rules. So every little retest, it actually didn't finally give a retest violation until the end of December this year on First Solar, and of course then it started coming down with the rest of the high volatile stocks. So First Solar is a great example. On the downside, I saved one of my favorite subprime stocks that we nailed last summer. We were talking about subprime for a long time, but you can see percent R in the top panel, but efficiency in the bottom panel. When efficiency is confirming percent R and you're below the acceleration bands, look at how sweet that is. When efficiency is coming in, percent R is again breaking down, and efficiency is breaking down, and then that thing went from 18 down to nothing as they shuttered all their offices and their subprime business went in the tank. Okay, last chart, and then I'm going to give you just a special that Jake and I wanted to share with you tonight. Here's the Dow. So this is updated through today's action. Well, look at the efficiency on our top panel. We've had two sweet spots in bearish efficiency this year. The first one was in January. We were below that bottom threshold. I'm not going to give it all away, but you can see caught that waterfall decline. The March decline wasn't that powerful. So basically, you have all kinds of situations in which, March wasn't that powerful, didn't really drop that much. But look at this last drop. When we broke down on efficiency, percent R was already there. That happened. Remember I said we went bearish June 9th? Well, look at why, because that's the fall off. Is there any reason to go bullish yet? Not in my world. Is it going to bounce at some point? Sure it is. But until then, I'm going to be in a situation in which I'm going to be saying, look, let's stay with the trend. The trend is your friend. Vada mentions, he says, all my examples have been with stocks or indexes. Do I have any that show how this would work with Forex? I would say go plug in any, use %R for starters. %R is available, and then you have to just change your settings. Or with Big Trends Toolkit, we already make it with the settings that I like. But if you use the same settings that I use here, you can see any trend there, Vada, on your Forex vehicles. Any meaningful trend, you're going to pick it up with %R, and the other tools are going to help you to back it up and confirm it. So you can see the real sweet spots that happen here. That's what we're really after, are those really strong, powerful trends. So that's how this works right now. You can see it's been a very bearish trend for the market. We've been loving it. If you're not making money in this, basically you have a situation here in which you're just not reading the charts right, and you're biased too much. You need to be positioned to catch these incredible moves like that last short signal and profit from it with put options. And there's very reasonable, low-risk ways to do that. So like I said, the Big Trends Toolkit offers you 14 different slices from acceleration bands, efficiency ratio, the way I use %R, all kinds of stuff I hadn't had time to talk about tonight. So these are all things that can really help you to be more effective. So this is something that we are offering just for a limited time.